When it comes to investing in a Roth IRA, the key is balancing tax efficiency, risk tolerance, and long-term growth potential. Since Roth IRAs allow your investments to grow tax-free, and qualified withdrawals are also tax-free, it's crucial to select investments that maximize this benefit. Here's a breakdown of the best investment choices and why they might work well in a Roth IRA, including tips for balancing risk and growth. Index funds and ETFs, or exchange-traded funds, are designed to track the performance of a specific market index, like the S&P 500 or the total stock market. This means you can get broad exposure to a large number of stocks or bonds with minimal fees. These funds are popular for Roth IRA accounts because they're tax-efficient and provide automatic diversification. They're particularly well-suited for long-term investors looking to benefit from overall market growth without needing to pick individual stocks. Examples include the Vanguard Total Stock Market ETF, which provides exposure to the entire U.S. stock market, including small, mid, and large-cap companies. It's highly diversified and covers a broad range of sectors. Another example is the SPDR S&P 500 ETF, which mirrors the performance of the S&P 500, representing the 500 largest publicly traded U.S. companies, including household names like Apple, Microsoft, and Google. For international diversification, the Vanguard Total International Stock ETF offers exposure to developed and emerging markets outside of the U.S., which can help reduce risk by not putting all your eggs in the U.S. basket. These are ideal if you're looking for a hands-off, diversified investment with minimal management. If you don't want to constantly track individual stocks, these funds provide broad exposure with very low maintenance. Target date funds are designed to automatically adjust their asset mix based on your expected retirement date. If you plan to retire in 2050, for example, you could invest in a Vanguard Target Retirement 2050 fund. In the early years, the fund will have a higher concentration of stocks for growth, and as you approach retirement, it will shift towards more conservative bonds and cash. These funds are ideal if you don't want to manage your portfolio actively. They provide a simple set-it-and-forget-it solution. A great option for investors who prefer a low-maintenance approach is the Vanguard Target Retirement Funds, such as the Vanguard Target Retirement 2050 Fund. These funds automatically rebalance as you approach your retirement date, becoming more conservative as time passes. If you're not comfortable with actively managing your Roth IRA and prefer a more passive, well-diversified investment that adjusts automatically over time, target date funds are a great choice. Dividend growth stocks or funds can be especially powerful in a Roth IRA because the dividends grow tax-free and can be reinvested without being taxed. Over time, this can compound significantly. Dividend growth stocks are often from established companies with a track record of increasing payouts. These are not just income generators, they also tend to have steady growth potential. Examples include the Vanguard Dividend Appreciation ETF, which invests in companies that have a history of growing their dividends, such as Johnson & Johnson, Coca-Cola, and Procter & Gamble. Another example is the Schwab U.S. Dividend Equity ETF, which focuses on high-quality U.S. dividend-paying companies, with an emphasis on those that consistently raise their dividends. If you're looking for a reliable stream of income through dividends but still want exposure to stock market growth, dividend-focused ETFs or individual stocks are a great option. Individual stocks for the risk-tolerant investor. Why do they work? Well, high growth potential is a big reason. Picking individual stocks can lead to substantial gains if you choose the right companies. Particularly in growth sectors like technology or biotechnology, a Roth IRA is a good place for this because the potential for growth is tax-free. Now, let's talk about risk and reward. While individual stocks can offer high returns, they also come with a higher level of risk. This is a strategy suited for those who are comfortable with volatility and have the time to research their investments. Some examples: tech stocks like Apple, Amazon, Nvidia, or Tesla are popular among investors who want to capture high growth potential. Emerging sectors like electric vehicles, clean energy, or artificial intelligence are also worth considering. When should you consider individual stocks? If you're young, have a high risk tolerance, or are willing to actively research and manage your investments, then this might be for you. But individual stocks may not be ideal if you're closer to retirement or dislike the volatility that often accompanies them. Bonds and bond funds. Why do they work? Lower risk and stability are key factors. Bonds are considered safer than stocks and can offer a steady stream of income. They're less volatile and are ideal for balancing the riskier parts of your portfolio, especially as you approach retirement. Another benefit is diversification. Bonds act as a stabilizer in your portfolio, and in a Roth IRA, the interest earned on bonds will grow tax-free. Let's look at some examples. The Vanguard Total Bond Market ETF, ticker symbol BND, offers exposure to a broad range of U.S. investment-grade bonds, including government and corporate bonds. Another option is the iShares iBoxx Dollar Investment-Grade Corporate Bond ETF, ticker symbol LQD, which focuses on higher-quality corporate bonds. When should you consider bonds and bond funds? If you're looking for a conservative investment with a steady income stream and lower risk, particularly if you're nearing retirement or have a low risk tolerance, then bonds might be a good fit for you. Real estate investment trusts, or REITs. Why do they work? They offer exposure to real estate without direct ownership. REITs allow you to invest in real estate properties without the hassle of buying and managing physical properties. They are especially appealing for their high dividend payouts. Another benefit is diversification and acting as an inflation hedge. Real estate has historically been a good hedge against inflation, which can be beneficial in uncertain economic times. Some examples include the Vanguard Real Estate ETF, ticker symbol VNQ, which invests in real estate investment trusts that own and manage commercial properties like shopping centers, apartments, and office buildings. Another option is the Schwab US REIT ETF, ticker symbol SECH, which provides exposure to U.S. real estate. When should you consider REITs? If you're seeking income through dividends and want exposure to the real estate sector for diversification, then REITs could be a great addition to your portfolio. Growth stocks or funds. Why they work. High potential for capital gains. Growth stocks typically reinvest their earnings to fund expansion rather than paying dividends. This makes them especially tax efficient in a Roth IRA, where the focus is on long-term capital gains. High volatility, high-reward growth stocks can be volatile, but they offer substantial long-term growth potential. They're well-suited to a Roth IRA, where you can afford to let your investments ride the market's ups and downs over time. Examples: ARK Innovation ETF RKK. This fund focuses on disruptive technology companies, including those in fields like artificial intelligence, genomics, and robotics. Vanguard Growth ETF VUG invests in large-cap growth stocks, including companies like Amazon, Microsoft, and Alphabet. When to consider. If you have a long investment horizon, 10 to 20 or more years, and are comfortable with risk, growth stocks are ideal for those seeking substantial appreciation over time. Cryptocurrency for the risk tolerant. Why it works. Potential for high returns. Cryptocurrencies like Bitcoin and Ethereum have shown massive returns over the past decade, and holding them in a Roth IRA allows you to benefit from their potential growth without paying taxes on capital gains. Alternative investment cryptos are an alternative asset class, and including a small amount can help diversify your portfolio. When to consider. If you're willing to take on high risk and are comfortable with the volatility that comes with cryptocurrency markets, cryptocurrency in a Roth IRA can be ideal for those who believe in the long-term potential of blockchain technology. Cash or money market funds. Why they work. Stability and liquidity. Cash investments like money market funds or cash equivalents, such as short-term treasury bills, can provide stability and liquidity, but they offer minimal growth, safety. These investments have low risk, making them a good option for those close to retirement or conservative investors who want to preserve their capital. Examples: Vanguard Federal Money Market Fund, VMXX, provides safety with very low risk and low returns. When to consider. If you're nearing retirement and want to preserve your Roth IRA value, or if you're looking for a safe, low-risk component in your portfolio. Alternative investments such as private equity and commodities. Why they work. Diversification and high returns. Alternative investments like private equity Commodities such as gold and silver or hedge funds can provide high returns and further diversify your portfolio. These options are often less correlated with the stock market, which can reduce risk. Access through ETFs. There are ETFs that give you access to commodities, private equity, or even venture capital without having to be an accredited investor. Examples: Spider Gold Shares, GLD, offers exposure to gold, which can be a hedge against inflation. iShares S&P Global Clean Energy ETF ICLN invests in the global clean energy sector, which has seen significant growth. When to consider? If you want to diversify beyond traditional stocks and bonds and are comfortable with the complexity or additional research required for these investments. Key takeaways. Diversify across asset classes such as stocks, bonds, real estate, and more to reduce risk and increase your chances of long-term success. Consider your timeline. If you're young, you can take more risk. If you're nearing retirement, you'll want to focus more on stability and rebalance periodically to ensure your portfolio remains aligned with your financial goals. Would you like to dive deeper into any of these options, or maybe talk through which investment might best match your current situation and goals? Please leave a comment below. Thank you for watching.
Thank you for watching. Kindly like, comment, and subscribe. Click on the notification bell so you can be alerted anytime a new video is uploaded. And please, don't forget, share and be a blessing to someone. God richly bless you. Shalom.